Imagine waking up in 2030, where working harder no longer guarantees stability. Prices keep climbing, wages feel frozen, and opportunities seem to move further away each year. This is not a distant theory or a dramatic forecast. It is the direction the UK economy is already pointing toward if nothing changes. Every decision made today quietly shapes jobs, housing, healthcare, and future security. The question is not whether change will come, but who will feel the impact first. What unfolds next affects households, careers, and the country's long-term place in the world, economically, socially, politically, culturally, and generationally nationwide. Number 1. Rising cost of living pressure. By 2030, if current patterns continue, the UK's cost of living will no longer feel temporary but structural. Prices for essentials such as housing, energy, food, and transport are projected to rise faster than household incomes. This imbalance slowly drains financial resilience, forcing families to rely on credit, reduce savings, or delay major life decisions. Everyday stability becomes fragile, and economic shocks hit harder because fewer people have a financial buffer to absorb them. Monthly budgeting turns into constant crisis management rather than forward planning. As disposable income shrinks, consumer behavior changes across the economy. Households prioritize necessities and cut back on discretionary spending, affecting retail, hospitality, travel, and entertainment sectors. Small businesses face weaker demand, while larger firms respond by raising prices further or reducing staff. This creates a feedback loop where lower spending weakens growth, and weaker growth limits job security and wage progression. Local high streets feel the impact first, with closures reducing community employment options. Over time, persistent living cost pressure reshapes social outcomes. Younger generations postpone home ownership, parenthood, and long-term investments, while older households struggle to maintain fixed living standards on static pensions. Geographic mobility declines because moving becomes too expensive, reducing labour market flexibility. When basic survival absorbs most income, innovation, entrepreneurship, and skills development suffer. An economy under constant cost pressure becomes defensive rather than dynamic, focused on coping instead of progressing, limiting national ambition, confidence, resilience, long-term prosperity, future competitiveness globally, sustained economic renewal, collective opportunity for growth, stability, inclusion, resilience, productivity, social cohesion, shared well-being, economic confidence, national morale, unity, economic optimism, long-term stability, shared prosperity, societal balance, cohesion, trust, and security. Number 2. Stagnant wage growth. If no meaningful reforms occur, wage growth in the UK is likely to remain disconnected from real living costs by 2030. Salaries may rise on paper, yet inflation-adjusted earnings continue to fall behind. Workers feel busier and more pressured, but financial progress remains out of reach. This disconnect weakens motivation and erodes confidence in long-term career prospects, especially in essential sectors like care, retail, transport, and public services, where pay growth remains limited. When wages stagnate, households reduce long-term planning. Saving for emergencies, education, or retirement becomes increasingly difficult, pushing more people toward short-term financial survival. Employers also feel the impact, as high turnover, burnout, and skills shortages increase recruitment costs. Productivity suffers because underpaid workers are less able to invest in training or maintain consistent performance. Over time, the economy absorbs these inefficiencies, slowing national output. Persistent weak wage growth reshapes social expectations. Younger workers delay independence, often remaining in shared housing longer, while mid-career professionals feel trapped between rising responsibilities and flat earnings. Income inequality widens as asset owners pull ahead, while wage-dependent households fall behind. An economy built on suppressed wages struggles to sustain consumption-driven growth. Without stronger income progression, innovation slows, social mobility weakens, and economic confidence declines across generations. This pattern limits ambition, discourages skill development, reduces household confidence, weakens tax revenues, pressures public services, and increases reliance on debt, leaving the economy vulnerable to shocks and slower recovery during future downturns. For workers, businesses, communities, regions, and long-term national economic resilience overall, nationwide.
Number 3. Growing public debt burden. By 2030, rising public debt could become a silent brake on the UK economy. Borrowing used to manage crises gradually turns into a permanent burden. As debt grows, more government revenue is diverted toward interest payments rather than infrastructure, education, or innovation. This limits fiscal flexibility and reduces the ability to respond quickly to future shocks. Markets begin to price in risk, pushing borrowing costs higher and narrowing policy options during downturns. High debt also reshapes political decision-making. Governments face pressure to raise taxes or restrain spending, both of which affect households and businesses. Investment projects are delayed, maintenance backlogs grow, and long-term planning becomes cautious. Businesses respond by limiting expansion and hiring, anticipating future tax increases. Over time, reduced public investment weakens productivity growth, slows regional development, and limits improvements in transport, housing, and digital infrastructure that support private sector efficiency. By the end of the decade, sustained debt pressure influences confidence across the economy. Consumers become cautious, expecting higher taxes or reduced services. Investors demand clearer returns, slowing capital inflows. Credit rating concerns amplify uncertainty even without formal downgrades. An economy constrained by debt becomes reactive rather than strategic, focused on servicing past obligations instead of building future capacity. Without structural change, public debt acts as a long shadow, reducing growth potential, resilience, and the ability to adapt to demographic, technological, and global economic shifts. This constraint shapes policy debates, narrows ambition, and normalizes lower expectations, leaving future generations with fewer options, heavier obligations, weaker public services, limited fiscal room, slower innovation cycles, constrained social investment, and diminished national influence in an increasingly competitive global environment marked by volatility, uncertainty, technological change, and shifting power balances.
Number 4. Deepening productivity crisis. By 2030, the UK's productivity problem could become one of its most damaging structural weaknesses. Output per worker has lagged behind comparable economies for years, and without change, this gap continues to widen. Limited investment in modern infrastructure, outdated workplace systems, and slow technology adoption restrict how efficiently people work. Employees may put in longer hours, yet overall economic output grows slowly, weakening national growth potential and reducing competitiveness across global markets. Low productivity also affects business behavior. Companies facing thin margins delay upgrades, reduce training budgets, and rely on short-term cost-cutting rather than innovation. Small and medium-sized enterprises struggle most, lacking capital to modernize operations. This creates uneven performance across sectors, where only a few firms benefit from efficiency gains while the majority fall behind. Over time, supply chains weaken, operational costs rise, and the economy loses momentum needed to sustain long-term expansion. The wider impact of weak productivity reaches households and public finances. Slower growth limits wage increases, reduces tax revenues, and restricts funding for public services. Regions already facing economic disadvantage feel the strain more sharply, deepening inequality. A productivity-constrained economy becomes trapped in low-ambition cycles where risk-taking declines and experimentation feels unaffordable. Without coordinated investment in skills, digital systems, and efficient infrastructure, productivity remains suppressed. This limits innovation capacity, discourages private investment, weakens export strength, and reduces resilience during downturns. By the end of the decade, productivity stagnation shapes everyday life, influencing job quality, income progression, business confidence, regional opportunity, and national economic standing in a world increasingly driven by efficiency, speed, adaptability, technological capability, skilled labor, innovation ecosystems, smart capital allocation, modern infrastructure, and competitive performance. Number 5. Shrinking middle class. By 2030, a shrinking middle class could redefine the structure of the UK economy. Rising housing costs, childcare expenses, and taxation pressures squeeze households that once felt financially stable. These families earn too much to qualify for support, but too little to build savings or assets. As security fades, spending becomes cautious and defensive. The middle class traditionally drives consumption, education investment, and entrepreneurship. So its erosion quietly weakens demand, reduces social mobility, and undermines long-term economic balance. This shift alters aspirations and changes how success and stability are perceived nationally across society today. As the middle class contracts, inequality becomes more visible and economically damaging. Wealth concentrates among asset owners, while wage-dependent households struggle to progress. Consumer markets polarize, with growth limited to luxury or discount segments. Skilled workers face higher stress and lower optimism, reducing risk-taking and innovation. Communities lose stability as people relocate for affordability, weakening local economies. Over time, this imbalance reduces trust in institutions and fuels frustration, which indirectly affects productivity, civic engagement, and long-term economic cohesion, while limiting upward mobility and narrowing opportunity for future generations. Nationwide, across the country. By the end of the decade, a weakened middle class reshapes national economic resilience. Fewer financially secure households mean lower tax stability and reduced buffers during downturns. Demand-driven growth slows as caution replaces confidence. Social cohesion suffers when progress feels unattainable. An economy without a strong middle relies more on debt and extremes of wealth. This structure proves fragile, limiting sustainable growth, innovation capacity, shared prosperity, and the sense of collective economic purpose for citizens, businesses, and future policy planning across generations in a changing global economic environment ahead. Number 6. Overstretched healthcare and social care system. By 2030, the UK healthcare and social care system could face sustained strain if no structural improvements are made. An ageing population increases demand for medical treatment, long-term care, and support services, while workforce shortages persist. Hospitals experience longer waiting lists, delayed treatments, and rising operational pressure. When healthcare systems operate near capacity for extended periods, efficiency declines and outcomes worsen, directly affecting workforce health, attendance, and overall economic participation across sectors. Pressure on healthcare also carries hidden economic costs. Poor population health reduces productivity, increases absenteeism, and pushes more people out of the labour market earlier than planned. Employers face higher insurance costs and greater difficulty retaining experienced staff. Public finances absorb rising expenditure without corresponding productivity gains. As resources shift toward managing illness rather than prevention, long-term health outcomes stagnate. This imbalance reinforces a cycle where economic weakness and health system stress feed into each other. Over time, limited healthcare capacity reshapes household decisions and national priorities. Families provide more unpaid care, reducing working hours and household income. Older workers delay retirement planning or exit work involuntarily due to health constraints. Regional disparities widen as underserved areas face poorer access and outcomes. An overstretched system reduces economic resilience by weakening human capital. Without reform, healthcare becomes a limiting factor on growth, innovation, labour participation, and fiscal sustainability, constraining long-term prosperity, competitiveness, social stability, workforce confidence, business planning, demographic balance, economic adaptability, and national well-being throughout the decade ahead, affecting policy credibility, investor sentiment, public trust, labour supply, social cohesion, economic confidence nationwide, and future fiscal planning capacity, resilience, adaptability, and strategic governance overall, nationwide, long-term sustainability. Number 7. Decline in global competitiveness. By 2030, the UK risks a steady decline in global competitiveness if existing trends remain unchanged. Investment in advanced manufacturing, digital infrastructure, and research continues to lag behind peer economies. Regulatory uncertainty and inconsistent long-term strategy discourage multinational firms from expanding operations. Export growth slows as domestic firms struggle to scale efficiently. When productivity, skills development, and innovation move slowly, international rivals capture market share, weakening trade performance and reducing the country's influence in global value chains. This erosion affects businesses, workers, and public finances simultaneously. Lower competitiveness reduces foreign direct investment, limiting job creation and technology transfer. Skilled professionals seek opportunities abroad where wages, resources, and ambition appear stronger. Universities and research centres struggle to commercialise ideas domestically. As exports underperform, currency pressure increases import costs, feeding domestic inflation. Over time, weaker competitiveness constrains tax revenues, making it harder to fund infrastructure, education, and innovation needed to reverse the decline. By the end of the decade, diminished global standing reshapes economic confidence. Businesses become cautious, favouring short-term survival over bold expansion. Trade negotiations carry less leverage, and supply chains bypass domestic firms. Consumers feel indirect effects through higher prices and fewer quality jobs. An economy losing competitiveness struggles to adapt to technological change. Without coordinated policy, skills investment, and strategic vision, recovery becomes slower, opportunities narrower, and long-term growth potential increasingly constrained. This environment discourages entrepreneurship, limits export diversification, weakens regional development, and reduces the ability to respond to global shocks, learning the nation economically reactive rather than proactive in an increasingly competitive international landscape, where speed, innovation, adaptability, and scale determine long-term economic success for countries navigating technological disruption and shifting global power dynamics. Number 8. Housing market imbalance. By 2030, housing market imbalance could intensify across the UK if supply shortages and affordability pressures persist. Demand continues to outstrip new construction, pushing prices and rents higher year after year. First-time buyers face larger deposits, stricter lending, and prolonged renting. For many households, housing absorbs a disproportionate share of income, reducing spending elsewhere. When shelter becomes unaffordable, labour mobility declines, families delay settling, and economic efficiency weakens as workers cannot relocate near opportunity. This imbalance reshapes financial behaviour and market stability. Investors gain advantage while owner-occupiers struggle, increasing reliance on rental markets. Rising rents push inflation higher and force wage pressure on employers. Construction delays, planning constraints, and infrastructure gaps prevent rapid correction. Over time, housing volatility raises financial risk, affecting lenders and pension funds. Local economies suffer as high costs deter skilled workers, limit business expansion, and reduce disposable income circulation within communities. By the end of the decade, persistent housing imbalance shapes long-term economic outcomes. Younger generations accumulate less wealth, widening intergenerational inequality. Delayed home ownership affects birth rates, savings patterns, and retirement security. Government faces pressure for subsidies, rent controls, and social housing expansion, straining public budgets. Without reform, housing acts as a bottleneck on growth, productivity, and social stability. An economy where shelter dominates household finances becomes less flexible, less innovative, and more vulnerable to shocks, limiting sustainable prosperity, confidence, and resilience nationwide. This pressure influences education choices, career mobility, urban planning, credit markets, household formation, regional development, political debate, investment priorities, community stability, and long-term demographic trends across cities and towns nationwide. Impacts remain persistent without coordinated policy intervention and sustained structural reform efforts over coming years. Affecting households, businesses, institutions. Number 9. Widening regional economic divide. By 2030, the UK could face a deeper regional economic divide if current patterns persist. Growth remains concentrated in London and a few major cities, while many towns and rural areas struggle with weak investment and limited job creation. Infrastructure gaps, transport limitations, and uneven digital access restrict opportunity outside growth hubs. This imbalance reduces national efficiency because talent and potential remain underused. When location determines opportunity, economic output suffers and regional frustration grows steadily. Uneven regional growth also affects labour markets and productivity. Workers in weaker regions accept lower wages or insecure employment, while businesses hesitate to expand where skills drain away. Young people relocate for opportunity, accelerating local decline and shrinking tax bases. Public services become harder to fund, reinforcing disadvantage. Over time, this cycle weakens small business ecosystems, reduces innovation, and limits supply chain resilience across the country. By the end of the decade, persistent regional inequality reshapes political and economic stability. Communities feeling left behind disengage from national growth narratives, reducing trust and participation. Housing pressure increases in prosperous regions, while empty properties rise elsewhere. Government intervention becomes more costly as gaps widen. Without balanced investment, transport reform, and skills development, the economy operates below capacity. A divided landscape limits mobility, productivity, cohesion, and long-term resilience, making growth fragile and uneven across generations and regions nationwide. This sustained imbalance increases policy complexity, strains public finances, reduces confidence among investors, weakens national integration, fuels social tension, limits upward mobility, discourages entrepreneurship, slows diffusion of innovation, and prevents coordinated responses to economic shocks that require unity, scale, cooperation, long-term planning, and shared strategic direction across communities, markets, regions, and generations. Number 10. Youth disillusionment and brain drain. By 2030, growing youth disillusionment could significantly weaken the UK economy if opportunities remain limited. Young workers face high housing costs, insecure employment, and slow income progression despite rising qualifications. When effort fails to deliver stability, motivation declines. Many graduates question long-term prospects at home and delay major commitments. This uncertainty reduces entrepreneurship, lowers consumer confidence, and weakens future tax bases. An economy that cannot inspire its younger workforce gradually loses momentum, creativity, and adaptive capacity needed to compete globally. As dissatisfaction grows, brain drain accelerates. Skilled professionals seek countries offering better wages, affordable living, and clearer career pathways. This migration removes innovation, leadership, and productivity potential at critical stages of life. Employers struggle to fill roles, increasing reliance on temporary labour or overseas recruitment. Universities educate talent that increasingly benefits foreign economies. Over time, reduced skill density limits technological adoption, slows business expansion, and weakens knowledge transfer across industries, reinforcing slower national growth. By the end of the decade, persistent youth disengagement reshapes demographics and fiscal stability. Fewer young workers supporting aging populations increase pressure on pensions and healthcare funding. Innovation ecosystems thin as risk-taking declines and startups struggle to scale. Social cohesion weakens when younger generations feel excluded from progress. Without credible pathways to security and advancement, optimism erodes. An economy that fails to retain its future workforce becomes less dynamic and more fragile. Addressing youth opportunity is therefore central to sustaining productivity, competitiveness, and long-term economic resilience nationwide. Long-term neglect compounds inequality, narrows policy choices, undermines investor confidence, and leaves future governments managing decline rather than building inclusive growth, shared prosperity, skilled employment pipelines, and durable institutions capable of adapting to global change. By 2030, the UK economy may not collapse overnight, but it risks becoming slower, more unequal, and less resilient if current patterns continue unchanged. Rising living costs, weak wage growth, strained public services, and declining competitiveness combine quietly, shaping everyday life in ways that feel gradual yet deeply transformative. The economy becomes harder to navigate, not because of one dramatic failure, but because multiple pressures build at the same time, narrowing choices for households, businesses, and future governments. What makes this outlook more serious is how interconnected these issues are. Housing affects mobility, wages affect productivity, healthcare affects labour participation, and youth opportunity affects long-term growth. When one area weakens, others follow. Over time, ambition gives way to caution, innovation slows, and confidence erodes. The result is an economy focused on managing limits rather than expanding possibilities. Yet this future is not fixed. Economic direction is shaped by policy decisions, investment priorities, and public awareness. Understanding where the current path leads is the first step toward changing it. The coming years will determine whether the UK adapts to global change or drifts behind it. What happens next depends on choices made now, not later. What part of this future worries you the most? Share your thoughts in the comments. Watch our previous video to understand how these changes started. Support our work by subscribing. One click helps us keep delivering deep, honest analysis.